Welcome to Module 8, where we'll be focusing on underwriting and financing residential properties. In this module, we'll learn how to evaluate the strength of a borrower, assess the value of the collateral, which is usually the property itself, and understand the risks involved in lending. These are crucial steps that lenders take to make informed decisions and ensure that loans are made responsibly and securely. Let's dive in and explore how these elements come together in the residential real estate financing process. Residential property underwriting is all about carefully assessing both the borrower and the property to make sure the mortgage is a good risk. Lenders dig into several important factors. They look at the borrower's credit history to see how reliable they are with payments, review their income and assets to confirm they can cover the loan, and evaluate the property's value since it acts as collateral. This comprehensive review helps lenders decide on the loan terms and determine how risky it might be to lend. Essentially, underwriting ensures that both the lender and the borrower are set up for success before the mortgage is approved. When we talk about underwriting, it's essential to understand the three main pillars that every decision is based on. The first pillar is the borrower, which focuses on whether the applicant can repay the loan. Here, we look closely at their credit history, stable income, and available assets to determine their repayment ability. The second pillar is the property itself. This evaluates whether the home supports the loan amount by considering its condition, how marketable it is, and its appraised value. This is what we call the collateral value. Finally, the third pillar is risk. This involves reviewing the overall loan terms, the ratios involved, and the documentation to ensure they align with the lender's acceptable risk profile, which we refer to as the approval standard. Together, these three pillars form a foundation for making sound underwriting decisions. When lenders evaluate a borrower's creditworthiness, they heavily rely on past behavior to predict future repayment ability. One of the primary tools they use is the credit score, which summarizes credit history into a range that reflects the risk of default. Generally, higher credit scores increase the chances of loan approval and can lead to more favorable interest rates and terms. Alongside the score, payment history plays a crucial role. A strong track record of paying bills on time reassures lenders, while missed payments, collections, or bankruptcies raise red flags and heighten concerns during underwriting. So, both the credit score and consistent payment behavior are key factors in assessing how likely a borrower is to repay their loan. When assessing income and mortgage underwriting, there are several key types of income we consider. First, W-2 income, which is typically verified through pay stubs, W-2 forms, and a consistent employment history. This helps confirm that the borrower has a steady and reliable source of income. Next, we look at self-employment income. This requires a more detailed review involving tax returns, business records, and an evaluation of income stability over time. Because self-employment can be less predictable, it's important to ensure the income is steady and sustainable. Lastly, we consider other sources of income that might include things like bonuses, alimony, rental income, or benefits, provided these are properly documented. The overall principle is that all income must be stable, well documented, and likely to continue in the foreseeable future. This careful income assessment is critical to accurately determining the borrower's ability to repay the loan. Let's talk about asset evaluation and reserve requirements, which are crucial when assessing a borrower's financial strength. First, we look at liquid cash, like savings and checking accounts. This is important because it shows whether the borrower can cover immediate costs such as a down payment, closing costs, and the required reserves. Next, we consider retirement accounts, including 401(k)s, IRAs, and similar funds. While these can strengthen the borrower's financial profile, lenders often discount their value due to potential penalties or withdrawal restrictions. Then, we evaluate investments such as stocks, bonds, and mutual funds. These can also support reserve requirements, but underwriters factor in market volatility, recognizing that these assets might fluctuate in value. Finally, real estate assets play a role too. Owned properties can add value through equity or rental income, but lenders carefully consider any mortgages or costs associated with those properties to get a full picture of the borrower's financial standing. Understanding these components helps ensure a comprehensive evaluation during the underwriting process. Appraisers use different approaches depending on the type of property and the market data available. First, there's a sales comparison method. This one compares a home to recent sales of similar properties, making adjustments for differences like size, condition, location, and features. It's the most common method used for owner-occupied residential lending because it reflects current market conditions. Next, we have the income approach. This method estimates the property's value based on its rental income potential. It's especially relevant for investment properties or multi-unit buildings, as it focuses on cash flow and market rent to determine value. Finally, the cost approach values a land separately and then adds a replacement cost of any improvements, while subtracting depreciation for age, wear, or any functional obsolescence. This method is particularly useful for newer, unique, or less comparable properties where other approaches might not be as accurate. Each of these methods offers a different perspective, helping appraisers arrive at a well-rounded valuation. Let's talk about loan-to-value, or LTV. LTV is a key ratio that expresses a loan amount as a percentage of the property's value. Simply put, you calculate it by dividing the loan amount by the property value. This percentage tells lenders how much of the property's value they're financing through the mortgage. A lower LTV means a borrower is putting down a larger down payment, which translates to lower risk for the lender. This makes LTV a crucial factor in underwriting and financing residential properties because it helps assess the risk level of the loan. Understanding LTV helps both lenders and borrowers make informed decisions about mortgage financing. Here we're looking at loan-to-value thresholds and how they impact loan approval. First, when the LTV is under 80%, this is conventional financing territory. It means lower lender exposure and usually no private mortgage insurance, making approval the easiest here. If the LTV falls between 80 and 95%, it becomes a higher risk band. Mortgage insurance is common in this range, and lenders expect stronger credit profiles and cash reserves as a cushion. Approval is moderately difficult, but still achievable with the right documentation and financial strength. When the LTV exceeds 95%, you're in the highest leverage category. This is the most challenging area for approval, as lenders limit the programs available, require tighter documentation, and usually want compensating factors like additional income or assets. Understanding these bands helps us navigate the underwriting landscape and manage the risk involved with each loan. Let's talk about the debt-to-income ratio, or DTI, which is a crucial factor lenders use when deciding if a borrower can afford a new mortgage. Essentially, DTI is a percentage of your gross monthly income that goes towards paying your monthly debts. This includes things like credit cards, car loans, and other obligations. To calculate it, you take your total monthly debt payments and divide that by your gross monthly income. For example, if you earn $5,000 a month and have $2,000 in monthly debt payments, your DTI will be 40%. Generally, lenders look for a DTI in the range of 43% to 50%, but often, the lower your ratio, the better your chances are getting approved with favorable loan terms. A higher DTI indicates more financial strain, which means underwriting is tighter and lenders may be more cautious. So, maintaining a lower debt-to-income ratio not only improves your likelihood of approval, but can also lead to better financing options and interest rates. Understanding DTI is essential for responsible borrowing and successful mortgage approval. Let's take a closer look at debt-to-income ratio, or DTI, which is a key factor in determining financial health when applying for a mortgage. First, consider all the monthly debt payments you have. This includes mortgage payments, car loans, credit card balances, student loans, and any other debts. To calculate your DTI, start by adding up all these monthly debt payments. Next, divide this total by your gross monthly income, which is your income before taxes and other deductions. Finally, convert this number into a percentage. This percentage represents your DTI. A lower DTI generally means you have a healthy balance between debt and income, which is favorable in underwriting and financing residential properties. Understanding these components and how to calculate your DTI is essential when navigating the mortgage approval process. Let's talk about how debt-to-income ratios, or DTIs, influence lending decisions. When your front-end DTI is less than 28%, this is considered excellent. Borrowers in this range have the highest chance of approval and usually receive the strongest financing terms. Next, a total DTI between 28 and 36% is seen as good. Loans here are commonly approved, especially if the borrower has solid credit and steady income. Moving higher, a total DTI between 36 and 43% is the upper range and still acceptable. While approval is possible, lenders become more selective during underwriting. Finally, if the DTI exceeds 43%, it falls into the high range. This situation is challenging for borrowers. Often, lenders require compensating factors, and the loan may be denied if those aren't present. Understanding these DTI categories helps clarify how lenders assess risk and determine loan approvals. Now, let's talk about underwriting documentation and what lenders typically require during the loan approval process. This documentation is crucial because it allows lenders to verify your financial situation and ultimately turns your loan file into a decision. First, pay stubs are essential as they show your current income and job status. Next, tax returns provide a comprehensive view of your income over the past few years, helping lenders confirm your financial stability. Bank statements are also required to demonstrate your available funds and financial habits. Employment verification is another key element, confirming that you have a steady job and income. Lastly, lenders will want to see valid identification and proof of assets, such as savings or investments, to ensure you have the resources for down payments and closing costs. All these documents together give lenders the confidence to make an informed decision about your loan application. This is a critical part of underwriting and financing residential properties, and understanding these requirements will help you navigate the process more smoothly. Now, let's walk through the underwriting process, which is essential in moving a mortgage application toward a final decision. There are 5 key steps involved. First, the loan application stage, where the borrower submits their request along with disclosures and the main financial information needed to start the process. Next comes the documentation review, where income, assets, credit history, employment details, and identity records are carefully verified to ensure everything is accurate and complete. The third step is the property appraisal. This is crucial because it tests the market value of the property and confirms that the collateral is sufficient to support the loan amount requested. After that, the underwriter conducts an in-depth analysis, weighing factors like the loan-to-value ratio, debt-to-income ratio, available reserves, and the overall risk of repayment. Finally, based on this assessment, the loan file is either approved with specific conditions, or declined. Each of these steps plays a vital role in making sure the loan decision is sound and secure. Now, let's talk about how the market value of a property is determined through the appraisal process. It starts with the inspection, where the appraiser carefully reviews the condition, size, features, location, and any visible issues that might affect the property's value. This step is crucial because it provides a first-hand look at what the property actually offers. Next comes the comparable sales analysis. Here, the appraiser looks at recent sales of similar homes nearby and makes adjustments based on differences like age, upgrades, lot size, and amenities. This helps establish a fair market value by comparing the subject property to others that have recently sold. Finally, all this information flows into the valuation opinion, the appraiser's final market value estimate. This opinion is vital because it helps confirm whether the property's value supports the loan amount being requested. Essentially, the appraisal acts as the lender's independent check, connecting the borrower to collateral and ensuring the loan is based on real market data. Let's take a closer look at how underwriting plays a critical role in risk mitigation for lenders. First, borrower risk is addressed by verifying credit to assess the borrower's reliability in making payments. We also confirm income and employment to ensure they have the ability to repay the loan. Additionally, reviewing assets and reserves provides a financial cushion in case unexpected issues arise. Altogether, these steps reduce the risk of default before the loan even gets funded. Next, property risk focuses on collateral itself. We order an appraisal to confirm the current market value and check the quality of the property to make sure it's in good condition and can be sold if necessary. Managing the loan-to-value ratio helps preserve equity protection, making sure the home can effectively support the loan as collateral. Finally, market risk is handled by applying program guidelines that align with investor standards to maintain consistency. We also stress test key ratios against potential changes in interest rates and costs to assess resilience. When there's more uncertainty, we use additional conditions and overlays to provide extra safeguards. This protects lenders if broader housing or credit market conditions shift unexpectedly. All of these aspects together create a robust framework that helps lenders manage and mitigate risk throughout the underwriting process. When we look at underwriting review, there are several red flags that can raise concerns. Primarily, these focus on three areas: the borrower's ability to repay, the stability of their income, and the strength of the collateral backing the loan. First, recent late payments can signal current repayment stress. This makes lenders less confident that mortgage payments will be made on time moving forward. Second, unstable employment, such as frequent job changes or gaps in employment history, suggests that future income might be unreliable. This adds uncertainty to the borrower's ability to maintain consistent payments. Third, a high debt to income ratio indicates that the borrower already has significant debt obligations. This reduces their capacity to handle additional housing costs comfortably. Fourth, a low credit score generally points to a higher risk of default. Lenders may respond to this by imposing stricter loan terms or even denying the application. Fifth, concerns about the property value can undermine the collateral strength. For example, a weak appraisal or issues with the property's condition can reduce its value as security for the loan. Lastly, insufficient reserves, meaning limited savings or emergency funds, show that the borrower has a smaller financial cushion to handle unexpected costs or payment shocks. Recognizing these red flags helps underwriters assess risk more accurately and make informed decisions about loan approvals and terms. Underwriting standards and compliance are fundamental in guiding every loan decision we make. First, federal regulations play a crucial role by enforcing fair lending practices to prevent discrimination and ensuring that truth in lending disclosures are accurate. These rules protect consumers by verifying their ability to repay loans and by offering strong consumer protections overall. Investor requirements also shape underwriting, especially guidelines set by Fannie Mae and Freddie Mac. These include strict eligibility rules, documentation, appraisal standards, as well as overlays related to loan-to-value ratios, debt-to-income reserves, and credit criteria. All these standards ensure loans meet investor expectations and maintain market stability. Internally, lenders have policies that define their risk tolerance and who holds loan approval authority. Quality control measures and fraud prevention are critical components, with any exceptions carefully tracked and applied consistently. Altogether, compliance safeguards not only borrowers and lenders, but also the health of the secondary mortgage market. This comprehensive approach ensures that underwriting aligns with regulatory, investor, and internal requirements, maintaining integrity and trust throughout the lending process. Conditional approval means that the borrower has met the initial requirements, but still needs to fulfill certain conditions before the loan can be fully approved. These conditions ensure that all necessary criteria are satisfied to move forward with the underwriting process. There are several common conditions borrowers might need to address. First, additional documentation may be requested to clarify or verify specific details about the borrower's financial situation. Second, there may be a requirement to pay off certain debts, which helps improve the borrower's credit profile and debt-to-income ratio. Third, an explanation letter might be needed to provide context or justification for any unusual items in the borrower's financial history. Fourth, an updated appraisal could be required to confirm the current value of the property being financed. Meeting these conditions is crucial because it helps underwriters assess risk more accurately and ensures that all aspects of the loan application comply with lending guidelines. Understanding these common conditions can prepare borrowers for what to expect during the underwriting and financing process for residential properties. Let's take a closer look at the different loan programs and their underwriting requirements. Starting with conventional loans, they generally require a minimum credit score of 620 and allow a maximum debt-to-income ratio of 45%. The down payment typically starts at 3%. It's important to note that borrowers with stronger credit scores and reserves often receive better pricing. Moving on to FHA loans, these are a bit more flexible. The minimum credit score is lower at 580, with a maximum debt-to-income ratio of 43%, and a down payment requirement starting at 3.5%. FHA loans are designed to accommodate borrowers with less than perfect credit while still qualifying them. Next, VA loans are quite unique. The minimum credit score can vary, but the maximum debt-to-income ratio is 41%, and no down payment is required. For these loans, eligibility criteria, residual income, and service status play a critical role in underwriting decisions. Lastly, USDA loans are geared towards rural properties. They require a minimum credit score of 640, maximum debt to income of 41%, and also offer a zero down payment option. However, there are income limits and specific rural property eligibility requirements to keep in mind. Each program has its own nuances, so understanding these underwriting requirements is key to matching borrowers with the right financing option. Now, let's talk about the cost of underwriting, which includes various fees and expenses that are important to understand. First, there's the appraisal fee. This is what you pay to have the property professionally valued. Then, the underwriting fee covers the lender's cost of evaluating your loan application. We also have the credit report fee, which is charged to pull your credit history to assess your creditworthiness. Next are the processing fees, which cover the administrative work involved in preparing your loan documents. Additionally, inspection fees might be required to check the condition of the property before the loan is approved. All of these upfront costs contribute to the total financing cash needs that you'll need to be prepared for when securing a mortgage. Understanding these fees helps avoid surprises and ensures you're financially ready during the underwriting process. Here we have a real underwriting scenario to walk through. The borrower is looking to purchase a $400,000 home with a 30-year fixed mortgage. Let's start with the borrower profile. They have a gross monthly income of $8,500 and a debt-to-income ratio of 41%, which falls within the limits for many loan programs. They also have $52,000 available in assets, which will cover the down payment as well as reserves. Moving on to the property details. The purchase price is $400,000 for a single-family primary residence. The borrower is putting 10% down, resulting in a loan-to-value ratio of 90%. An important factor here is the appraisal, which came in at $405,000, slightly above the contract price, providing a small cushion that supports the collateral's value. Based on this information, the underwriting decision is to approve the loan, but with certain conditions. The borrower's income supports the monthly payments, and the DTI is acceptable, so repayment ability is solid. The collateral is also supported given the appraisal value. However, to reduce risk, the lender requires verification of the final bank statements and confirmation that the borrower maintains the required cash reserves before closing. Overall, this case illustrates how income, assets, property value, and risk mitigation come together in the underwriting process to reach a conditional approval. Technology is transforming modern underwriting by making every step faster and more accurate. Digital tools significantly reduce the time needed for review while enhancing the quality of lending decisions. For example, automated document verification speeds up the validation of pay stubs, bank statements, and IDs, cutting down manual work. Real-time debt-to-income analysis keeps borrower ratios updated instantly, allowing for quick and precise evaluation. Digital appraisal tools, including automated valuation models and platforms, streamline the assessment of collateral properties. Meanwhile, AI-driven risk assessment uses predictive models to identify potential issues like fraud or repayment risks early on. This technology shift means underwriting systems are smarter, supporting faster, more consistent decisions that benefit both lenders and borrowers. Here, we're reviewing two key metrics that play a critical role in mortgage approval, pricing, and loan structure: loan-to-value or LTV and debt-to-income or DTI. Starting with loan-to-value or LTV, it's calculated by dividing the loan amount by the property value. This ratio gives us insight into the collateral strength and shows how much equity exists to protect the lender. When the LTV is 80% or less, the risk is lower, pricing tends to be stronger, and many conventional loans don't require mortgage insurance. Between 81% and 95%, it's a common approval range, but often mortgage insurance comes into play or lenders impose tighter loan terms. Above 95%, loan options become limited. There's higher scrutiny and less room for error in property value estimates. Moving to debt-to-income ratio, or DTI, this is calculated by dividing a borrower's monthly debt payments by their gross income. This ratio measures a borrower's ability to repay the mortgage and whether they can comfortably support the new loan. A DTI of 36% or less indicates strong affordability and offers more flexibility for underwriters. Between 37% and 43% is typical for approval, especially when credit history, income stability, and reserves are solid. Once it goes above 43%, the borrower faces higher payment stress, and approval standards become more restrictive. Ultimately, strong loan approval depends on a balance between equity protection through LTV and a borrower's repayment capacity through DTI. Both metrics together shape the loan decision, pricing, and structure, ensuring a manageable level of risk for the lender. Now, let's look at some common underwriting challenges and their solutions. First, self-employment income can be tricky to verify, so lenders usually require 2 years of tax returns, year-to-date profit and loss statements, and a letter from a CPA to confirm income stability. Next, a high debt-to-income ratio often raises concerns. To address this, borrowers can pay down existing debt, provide documentation of stable income sources, or bring in a co-borrower to strengthen the application. Lastly, limited cash reserves can be an issue, but this can be resolved by verifying gift funds, proving access to liquid assets, or meeting required post-closing reserves. Understanding these challenges and their solutions helps streamline the underwriting process and improve approval chances. Let's review the core takeaways from this module on underwriting and financing residential properties. First, underwriting's main purpose is to match the loan approval in terms to the measured risk, ensuring that the lender is protected. To do this, we conduct a thorough borrower evaluation that reviews credit history, income, assets, and repayment capacity. Financial ratios, especially loan-to-value, LTV, and debt-to-income DTI, play a critical role in influencing both loan approval and pricing. Risk assessment involves testing the borrower's financial strength alongside the value of the property serving as collateral. Finally, all major underwriting decisions must be supported by verified documentation, ensuring accuracy and reliability throughout the process. These elements together create a structured, risk-aware approach to financing residential properties. On this slide, we're highlighting the key learning objectives we've achieved in this module on underwriting and financing residential properties. We've covered the underwriting process itself, which involves thoroughly assessing the borrower's financial background and the property's value. We also took a close look at important financial ratios, namely the loan-to-value ratio and the debt-to-income ratio, which are critical in determining loan eligibility and risk. Lastly, we've evaluated how underwriting acts as a risk mitigation tool, helping lenders manage potential defaults by carefully analyzing all relevant factors before approving a loan. These core concepts form the foundation for understanding residential property financing. Now that we've covered the key concepts, let's talk about the next steps for applying your underwriting knowledge effectively. First, review real transactions closely. This will help you see how different borrower profiles, property details, and loan programs influence approval decisions in the real world. Next, practice ratio calculations. Getting comfortable calculating loan-to-value ratios, debt-to-income ratios, reserves, and monthly payment scenarios will boost your confidence and speed when evaluating files. Finally, study various case studies. By comparing strong files, weak files, and those with conditional approvals, you'll sharpen your ability to recognize what drives different outcomes. These steps will solidify your skills as you move forward in underwriting residential properties. As we wrap up, I want to highlight some valuable resources and areas for further learning that can really boost your underwriting expertise. Start by exploring key industry organizations like NMLS and the Mortgage Bankers Association. These groups offer essential information on licensing and industry education. It's also important to stay informed about regulatory bodies such as HUD and the CFPB, as they provide guidance on federal housing rules, borrower protections, and appraisal standards. To deepen your knowledge, focus on topics like automated underwriting systems, the differences between agency and non-agency loans, and how to review appraisals and assess collateral risk effectively. Understanding how program guidelines affect risk and documentation is crucial, as is learning about value support methods, comparables, and identifying red flags during appraisal reviews. Remember, strong underwriting skills come from a solid grasp of standards, regulations, and plenty of practice. Keep building on what you've learned here by using these resources to sharpen your borrower analysis, collateral review, and overall mortgage decision making. This continuous learning will help you stay confident and competent in underwriting residential properties.